Good evening, everyone, and thank you all for joining. Let's just give it a couple of minutes because I can see that others are constantly coming in here. I think there's about 25 of us at the moment. No, 31. There you go. It shoots up rapidly. Who have we got? I can certainly see some very familiar faces here, and always lovely to see the new ones as well. So welcome. Can you all just do me a favour, please? Give me a wave, put something in the chat box just so that I can see that absolutely every piece of tech is working. I can see a few wavy hands. Hi there, hi there. Can someone put something in the chat for me, please? Just need to make sure the chat box is working. Anybody? Hello, hello. Chat's okay. Something in the chat. Very clever, Tiravan. Very clever. Something in the chat. Hi, Claire. How are you doing? Oh, Mr. Whittingham is on board as well. Who else have we got here? Colette, Mike, hello, Mike. Long time since I've seen you. Mahmood, Lee. Lovely to see you, Lee. And of course, we've got Mr. Paul Aylett. So, hi, Paul. How are you doing? Nice to see you as always. I'm actually going to give a shameless plug here to my friend and business partner, Paul Aylett. So, Paul is Fabrik's second biggest fan. Of course, I'm number one. Goes without saying. But do check out Paul's app called TivGrow. TIV Grow, all one word, which will give you everything you need to know about starting your property journey, particularly with buy-to-lets. So there we go, shameless plug for you, Paul.
Thank you very much, most appreciated, Lynn. It's always a pleasure to be here.
Absolutely love having you. Paul and I talk often, so yeah, another little plug for in there is very much well deserved. So I think we've got enough people to get going. Yeah, we're sort of on the 40 level, so let's just jump straight in there. So welcome to this Fabrik Property Group webinar, and thank you to each and every one of you for joining us. For those of you who don't know me, I am Lynne Whittingham of Key to Freedom, and I'm delighted as always to be invited to host the Fabrik webinars. The topic of this particular webinar is why the top 1% are investing in UK property right now. So first of all, for everyone that stays to the very end, Fabrik are going to be giving away not one, but two, yes, two gifts worth over £1,000. I can hear you all shouting out, yay, not another ebook. Well, I can assure you it isn't. But if I'm going to let anyone tell you what these are, it will be Stevie about the gifts a little bit later. So bear with us there. Fabrik will also send you all the slides from this evening. So don't worry about taking notes, etc. Unless there's something specific you want to. You'll have all the slides later on. And we're also going to be running a Q&A session at the end. So please do add your questions into the chat as we go. If I could just ask you though, please, if you could just put the name of the person that the question is directed to, that would help me enormously. So whether it's Steve, Jake or Liam, I would really appreciate that if you could. So without further ado, and feel free to unmute, clap and cheer and just bang on the desk, whatever you feel like doing along with me. It gives me huge pleasure to introduce you to you today from Fabrik Property Group, the CEO, Mr. Steve Jacob, from Global Residentials, Mr. Jake El-Rousal, and from Get Ground, Mr. Liam Rogan. Yay! Oh, do you know what? I'm so pleased. There's people clapping. I feel like I'm the only one at the party. So I appreciate that. Thanks, everyone. So, Stevie, it's certainly always a pleasure to introduce you to the show. And it gives me the opportunity, let's be honest, to get my own back. And so today's going to be no different. I hope you're prepared for this. So I've had the pleasure of working with Steve now for over a year. What can I tell you? He is a tremendous businessman. That comes from the heart. He's a true, tremendous businessman. But also something else that he's equally good at. And I'm going to be honest, he's a huge pain in the backside. So I just wanted to get that one in there for those of you that didn't know that. But however, all jokes aside, you started in business at the young age of 12. And it seems you were a naughty boy back then, as you were kicked out of school at 14. You've remained an entrepreneur all of your life, but it's true to say you've both made and lost a lot of money during that time. You've now built yourself a hugely successful company and have added Fabrik Invest to your group of companies, which are focused on buy-to-let property. Welcome, Mr. Jacob.
Thank you very much, Lynn. Love your energy as usual.
That's why Thank you. I love having you here. And you don't mind the criticism either.
No, the criticism is fine.
It is tough if you do, but hey.
I wouldn't like it if you said I was a softie. Then that would have wound me up.
Yeah, definitely not a softie. So, Jake El-Rousal, what an awesome name. It's like, you know, I feel like I'm with somebody very famous in. Not to say that you're not Jake, but it makes me feel like I'm with the A-listers, the film stars. So I'm just going to say that again, people. That's Jake El-Rousal. Lovely. So Jake has been working overseas for the last 7 years, specialising in UK residential property investments. He's a specialist advisor to local and overseas clientele. And Jake is a key figure behind Global Residential's route to market, including private banks, wealth management, and real estate advisory. Welcome, Jake.
Thanks, Lynn. What a great introduction, and thanks for having me on board.
You're very welcome. And Jake, actually, for all of you guys out there who are sitting in rather a cloudy England at the moment, Jake is coming to us all the way from Dubai. So, but he did tell me yesterday it was somewhat chillier than England. So, so I'm quite glad about that. Little small winds, hey. And last but by no means least, Mr. Liam Rogan. Liam is a key account manager at GetGround, helping both UK and non-UK residents best structure and enhance their investments within the UK property market. GetGround is a fintech company backed by the UK government, by HM Land Registry, that allows UK investors to maximise the value of their investments cost effectively from anywhere in the world. Welcome, Liam.
Thank you very much for your kind introduction, Lynn. Appreciate it. Unfortunately, I don't have a name quite as impressive as Jake's. Neither am I in Dubai either. I'm in sunny old Liverpool right now, which is absolutely chucking it down. But yes, it's a pleasure to be here. Thank you very much. I'm looking forward to the...
You're very welcome. And we forgive you for living in Liverpool.
It's a curse and a burn sometimes.
Do you support the Liverpool team as well?
I do indeed. Last night.
Yeah, okay, that's enough from you. I think Liam's dropping out of this, actually. No, in all seriously, welcome, Liam. Lovely to have you here. And so coming up in the show, we have a special section from Jake and Liam. Jake will be giving us a global perspective of the UK property market and why his investors are using UK buy-to-let as an investment vehicle. And Liam will be speaking about the tax benefits of investing in UK buy-to-let property. And we certainly all like to know about some tax benefits for sure. So, okay, guys, I'm really looking forward to this. Stevie, I'm going to hand over to you now, please.
Okay, fantastic. Thanks, Lynn. Thanks, Jake and Liam for coming. I'm really looking forward to your bits of the webinar. I'm going to warn you now, everyone. They've left me in control of the tech, and that may have been a bad decision. So I'm pressing the buttons. Already, I've made one mistake. Right, so why invest in UK property? Well, I think, first of all, it's important for me to tell you how I got involved in UK property so you can understand where I'm coming from. So prior to being a property investor, I was a city broker dealing in the investment sector. So I was regularly selling packaged investments to investors, And I'll be honest with you, it was quite stressful. We were put under quite, you know, a lot of targets, a lot of pressure. And the first of the month come around very quickly, and I was very much felt like a hamster on a wheel. I was standing in a good friend's jewellery shop, and next to me was a guy. I sort of already knew the guy standing next to me. He was known as a smart cookie. He was a Grant Thornton auditor, and he was friends with my friend's son. And he was talking about property. I overheard the conversation. He was really educated. You could tell from the stuff he was saying. So I invited him for dinner, and we went for dinner that night, and he told me about the wonderful world of property. And I basically decided that night that I was going to start winding down in the city and go full time with him. And I asked him if he was okay with that. And we partnered on that day. And that was Matt Harper Penman, who's still with us today. We're still, you know, business partners today in one of the arms of the companies. And when I got speaking to him, he'd been on an education course. And, you know, when we look back on the journey, it maybe wasn't the best advice that he was given. We could have got maybe better advice early on. And that's why we feel these webinars, we can share with you guys the things we did wrong, and you can, you know, maybe learn from us. So we were told to go north of Birmingham for yield. I thought that was probably the best bit of advice we got. We ended up taking that seriously, and we went to Blackpool. When we first landed in Blackpool, you know, it did have a bit of a bad name in the newspapers and stuff like that, but we thought of Warren Buffett, you know, be greedy when others are fearful and fearful when others are greedy. And we got to know the market. But at first, we were inexperienced in the process. So one of the things that I would say to everybody out there, you know, not everybody out there, some people out there want to buy a fully managed investment. And, you know, that's good for certain people. And some people want to buy tired properties, do them up, and, you know, use a management company. One of the early mistakes we made is choosing the cheapest builder, not vetting the builder's work. Going on face value of people because you think people are like yourself. You think, you know, if someone's telling you something, then it's true. And the first few builders we had were painful, to say the least. So one of the bits of advice I'd say is, if you are going into do the stuff yourself, the construction phase is always a risk, whether it's a small development or a big development, and you have to really keep your eye on it. We then bumped into the wrong management companies who didn't manage the tenants very well, and that caused us a lot of pain. And we also didn't undertake huge market research early on and bought in the wrong areas. But anyway, it wasn't all negative. We were very determined, and we pulled ourselves out of that. We managed to find the areas in the town that were generating the best cash flow, because that is what Blackpool was about. It was a pure cash flow play. And we met the right people, and we ended up bumping into the right solicitors and the right accountants. And we ended up building a portfolio. And I think now we've got about 50 tenants with a complete mixed bag of professionals, BSS, commercial. Oh, someone come in there. A mixed bag of tenants. And I'd say that was one thing. I met a valuer very early on who said to me, build yourself a solid foundation of buy-to-lets that can, you know, perform with positive cash flow, and then begin to add some commercial into your portfolio. And there's ways at which you can extract profits out of companies via a SaaS pension. So that's been an addition to our strategy to now. But yeah, I'd say, if you are going to enter property, build yourself a solid foundation of buy-to-lets or small, you know, I know that serviced accommodation is a great investment, small serviced accommodation units, and then build your portfolio from there. But, you know, we look back and I think 50 tenants, like, how the hell did we get here? You know, and I talk to people on the phone and they say, how did you get to 50 units? And you just get good at it. You know, some of you out there will be from a variety of different industries. If I was talking to a guy the other day who sold jet fuel, I would have no idea where to start selling jet fuel. You know, I would have no idea where to start. But if you do something for long enough, you get better at it, and that's another lesson. So having a mixed profile of tenants and building your portfolio with buy-to-lets at the start. Yeah, so the Northwest is definitely a very, very good place to get yourself a solid yield. You've got the Northern Powerhouse regions. I think Manchester's having about 20 billion of government funding invested into it. Liverpool's got about 5.5 billion being spent there. And even small pockets of the Northwest like Blackpool have got over £1 billion worth of investment going there now. And a lot of the major companies are moving to Manchester, Liverpool now. And, you know, in towns like Blackpool, the major hoteliers are moving in. So as an investor, one thing you want to do is you want to sort of piggyback on the back of the market research that these guys have done, because they've targeted these regions for a reason. You know, if an employer, a large employer has gone to Manchester, they must feel that they can get the right quality of staff to, you know, fuel their business and keep it moving, which is really important, because then you're going to, that's going to be your tenant. That is going to be your tenant, and you've got to think about stuff like that early on. So yeah, we're big advocates of the Northwest, and it's definitely somewhere we are constantly advising people to look at. Yeah, so I touched on it a little bit earlier in my story, but the biggest lessons I've learned in property are finding the right people. So whether that be the right solicitor, the right mortgage broker, because you'd be very surprised. There are extremely good and extremely bad, and you just want to make sure you're getting, and I'd say go based on recommendation. If you can get something recommended from someone you trust, that is always the first route for me. I know that Jake on the call at Global Residential, we wanted the best off-plan buy-to-let mortgage brokers because it was a different sector. We got put in touch with a woman called Donna in Dubai. I think her company's called IFPG. Jake, you can let them know in a bit. But she was fantastic, and she's been great with all of my clients as well. So as well, finding the right management companies, the right builders. If you are doing it yourself, if you're going the fully managed route, less of a worry. You just want to vet the developer, make sure that they're credible, make sure that the people you're taking the advice off are credible. But if you're going down the whole refurb management route, there is a lot of risk there. So just make sure you're vetting the builder and manager and getting the correct recommendations from people you trust. I want to make it one thing clear. When I was in the city, I was in a position where I was really stressed out and I just wanted to get out. And I made the decision to go into property very quickly without undertaking a plan. I didn't get myself a plan and a strategy. And I mean, property can take me in 100 different directions. I mean, I've done HMOs, buy to refurb to flip, sourcing, residential lets, commercial lets. And it's good because I've built myself a bank of knowledge and I know what I want to do and what I don't want to do now. But it was trial and error. And a lot of the people that I'm speaking to at the moment, you know, I'm telling them not to buy until we've sat down and had a strategy call and understood, you know, what I'll do is I'll put them in touch with Liam at GetGround, who will talk to them about how they're going to structure their company for tax purposes. I'll put them in touch with the mortgage brokers first so that they can figure out, especially if they're international, like how are we going to get you the best mortgage rates? Once you've got them, and as well, you know, if you've got a cash flow target, how quickly are you going to get to that target and what strategy is going to get you there the quickest? And someone can advise that. You can sit with someone for a couple of hours, get that plan in place and just stick to that plan. So, and another thing, if you love your job, which a lot of people I speak to do, they actually really enjoy the business they're in and really enjoy what they do. You don't want to be doing refurbs and finding your own management because it is time consuming, frustrating and stressful, and you're juggling two businesses. And if you chase two hares, they'll probably both get away. If you love your job and you want to carry on doing that, then go for the fully managed route. That is definitely a bit of advice, I'd say. So I hope that helps and I hope you got something from that. Like I say, we could talk about property for hours. I've got to try and condense this down so that it's helpful for as many people as possible. Strength in the UK buy-to-let property market. There's a huge amount of strength in the UK buy-to-let market. When COVID hit, now I was hit hard because the business arms, the arms in this business, they range from finance broking to land sourcing to I had builders on sites, sales going through, I had people buying and I was selling, and basically all that ground to a complete halt. And it's been, you know, we're coming out of it now and it's quite positive. The bounce back's been quite positive. But throughout all this, my buy-to-let portfolio coughed out all the way through. You know, I'd say 90% of my tenants paid. That, in my eyes, is because people rank their home as high on the importance scale. So it's very important that they pay that bill, you know, and, you know, a few tenants couldn't pay the bill, but asked for deferred payment. And this is where the manager became very important. He was constantly on the phone to me, and, you know, there were people trying their luck. Commercial tenants were trying their luck. So he was saying, well, if I found out you've took the bounce back loan and you're not paying your rent, well, that's, you know, wrong. And then they'd pay because I had taken the bounce back loan, but they were trying. But then from another scale, there were residential tenants that genuinely were in hardship. You know, there was a chef and he was a nice guy and he asked to defer his money and pay it over 12 months once things kicked off. And, you know, we were fair. We had to do that. But throughout this, the buy-to-let portfolio kicked our income all the way through. So hopefully we never get this sort of situation again, but it showed me the resilience of a buy-to-let portfolio. And going forward, I will make sure I'm always adding properties to the portfolio, buy-to-let properties. I think the model is very simple to understand. You know, there's all these different investment vehicles out there. I've worked in the investment industry. If you're going to buy a company, for example, from the stock market, you don't just buy what's hot in the news. You have to read the financial statements. You have to know the PE ratios. You have to know that that company is a good price, you know, and you can't see that from the price. It's nothing to do with the price. The price and the value are two completely different things. But there's a lot of work involved. With a buy-to-let property, you can go on Rightmove, find out what it's worth. You can find out what the local rents are, and you can quickly calculate what your return's going to be. There's going to be risks, but it's pretty simple to understand. And then if you add a mortgage to the property, you can work out your return on cash invested very easily. I mean, we've got a calculator in-house here. We plug the numbers in and out coughs the cash on cash return, which I think is really important because that is your true return on cash. So I think it's a very simple to understand model. It's not complex. And that's why I think people that get into property get very good at it very quickly. You know, it only takes a few property deals and you become very good at reading numbers and analysing markets. And all the information's out there as well. It's all very much public domain. Right now, the biggest reason people are flooding to the UK property market, and the most interest we're getting at the moment in Fabrik is for small buy-to-let properties. And that's because of the borrowing rates, especially overseas investors. They're wanting to take advantage of the borrowing rates. And I think they will be record low borrowing rates. I think throughout history, we'll look back and go, you know, why didn't we take advantage of them more? You know, and I think that's really important. If you're going to be buying property now or you own property, I speak to so many people that have got multiple properties owned outright. And I just think right now is a good time to get them properties refinanced and, you know, fix the term. So, yeah. There's good incentives to buy property. I mean, at the moment, the government have released good incentives to buy properties. So if it's your first property, you can get it free of stamp duty up to 500k. If it's not, they've given you a stamp duty holiday so that you can push that back. You still have to pay 3%, but they've allowed you to pay 3% up to 500k now. So I think from an article I read, if you bought a £500,000 or £499,000 property, there's about £15,000 stamp duty saving in that property since the government made the announcement a few weeks ago. There's good incentives to buy property as well right now, directly from developers. Coming out of coronavirus, they've been very good. They want to do deals, so they're offering good incentives, good payment plans, and throwing in a few little extras like free legals and furniture packs and stuff like that. So I think there's a lot of good incentives to buy right now. As I said earlier, it is a solid foundation. It's proven that to me. Like Lynn said, I've been in the world of business from a young age, and I've had the ups and downs, but the buy-to-let portfolio is very consistent, and is definitely my safest company and safest investment. It's really important, and I touched on it earlier, the importance of a strong team. The management company I work with up there were really, really good throughout the whole of coronavirus. Like I spoke to him so much, he probably got sick of hearing my voice. But, we was in worried times, we were picking up the phone every day, like, how's it going? Did so-and-so pay? We probably didn't need to call as much as we did, but we weren't really doing much else. I think most would agree. I was working every day, but it definitely wasn't as busy. But these guys were really, really good throughout the whole process. And also part of my team are my estate agents, and the hungry ones worked all the way through coronavirus, COVID. So the importance of a strong team. So I'm going to hand over to Liam now. Liam is someone I've grown massive respect for, because the amount of time he puts into all of Fabrik's clients. My clients have had half-hour to hour-long phone calls free of charge with all the tax advice needed. I've listened to the advice. I've checked out the advice. It's all sound. And I'll let Liam take it away. There you go, Liam.
Excellent. Thank you very much for that, Steve. Very much appreciate being here tonight, and lovely to meet you all. In the same vein as what Steve was saying before about the importance of having a strong team, it's crucial to success in any property investment. And, guys like Fabrik and Global Residential and other companies are fantastic for, making sure you get the best returns on your investment in general. But what's also important to consider is how much of those returns on that investment are you actually going to get to keep, post-tax, post all your other fees. It's something which is extremely important to understand right from the off, because if you don't make the right decisions from the off, it can really sting you further down the line. And it's essentially what we try to do at GetGround. We try to be part of your team going forward, and our clients' team with their property investments, to make sure they get as much out of their investment and truly maximize their returns and the value of their investment as possible. So we essentially do two things. We educate the market as to the benefits of using limited companies, and help people really understand how extensive the benefits really are, because it's such a misunderstood field. And I have clients every day who have heard this thing from here and this thing from here, and they're either complete outright lies or just misguided or whatever may be the case. And so it's something we care very deeply about, is helping to educate both our clients and the market in general how extensive the benefits are to limited company buy-to-let and how to access them as well. And so the secondary part of what we do is we basically make it really easy and straightforward and cost-effective to take that route. And so I'll go into that a little bit in a minute, but I thought first part, I'd like to just kind of educate you all and help you understand a little bit more about why people are using limited companies for their buy-to-lets and how beneficial it can be. So somewhere in the region of 80% of buy-to-let mortgage applications last year were in the name of limited companies, to give you just an idea of how popular a route this has become. And the reasons for this are kind of in two buckets, essentially. So the first bucket of advantages, which has attracted people towards the market, is the tax efficiencies. So essentially, everybody wants to increase their post-tax profit, and limited companies are definitely something that can help with that. But we take at GetGround a very holistic view to using limited companies, and we want to maximize the benefits that are afforded to people using them and using our limited companies. And so there's another bucket of benefits, which is probably quite difficult to title. It's kind of a miscellany of a number of benefits, but I'll address them in a minute. But I think that the first one to address it is the tax efficiency. So where do these benefits lie and how are they accessed? So to begin with, it's probably best to view these benefits throughout the investment, so from purchase through to sale. So one of the first things I like to clarify with clients, both the guys I've spoken to at Fabrik and in general, there's a lot of misconceptions around the stamp duty that's paid on entry. And people seem to be very much of the understanding that you pay a higher stamp duty land tax when you use a limited company for your buy-to-let investment. That isn't the case. So the entry costs using a limited company are the same as owning in your personal name. So there's no change there. Now, the real benefits kick in when you start to own your property even. And the first one is that in limited company name, you can still deduct your entire mortgage interest from your UK tax bill. And that's something you can't do in personal ownership anymore. That's been phased out. So in personal ownership, that's been replaced by what's called a basic rate credit. And so as an example, in limited company ownership, what you can still do is if you were to have £2,000, say, of rental income come into your account, and you had £800 of mortgage interest, you would be able to deduct that £800 as a business expense, and then you would pay tax only on that £1,200 that was left over. Now, the big benefit that comes alongside that as well is when you own a limited company name, the tax you pay is at corporation tax rates, which is lower than any other income tax brand. So you're essentially paying a smaller amount of tax on a smaller pot of money. So overall, increasing your post-tax returns. And you can very efficiently get that money out of your company without having to face income tax by paying yourself a salary or anything like that. And so for our international clients, so we work with clients around the world. We have offices both in Singapore and Hong Kong as well. You would probably be best taking your money out via way of dividends. It's an extremely tax efficient route. And for UK clients, you would extract your funds via owner loan repayments, which is another very efficient route out. So during the ownership period, you basically make a huge saving there. But moving on to exit, two of the benefits that we're trying to increase knowledge about and increase access to is the ability to increase your means by which you can sell. So when you use a limited company, you have two options on exit. You can either sell the property from the company, or you can sell the property by selling its shares. And when I say by selling its shares, the best way to view this is you have your property, and you're still selling the property, but imagine there's a wrapper around it. And the wrapper around it is the company's shares. Now, when you sell the company's shares, two huge benefits are afforded to you. The first is that there's a tiny amount of stamp duty land tax that is due on the sale of shares. So as an example, if there was a property for £500,000 in normal times, so not the current SDLT regimen, but normal times, a property for £500,000 would incur stamp duty of about £30,000. And obviously that's an extremely high entry cost for anybody trying to purchase that property. And so what you could do is you could sell the shares, and they would basically not have to pay that amount. And so what that gives the seller the advantage is the advantage to have a price increase, essentially. So in that example, what the seller could do is basically increase the price of the property by £20,000. And the buyer would still be happy to purchase that property because not only are they getting the benefits of owning a limited company name by having that property in the limited company, but they're making a significant saving on the SDLT side of things. So overall, the seller is increasing their capital gain, and the buyer is making a big saving on the SDLT and the entry costs. Now, the other big benefit that incurs there is that there's significantly less capital gains tax due on the sale of shares than there is on property. So what you're essentially doing is you're increasing your overall capital gain, and you're decreasing the tax that is due on that gain. So overall increasing your investment returns. Now, this is something that isn't really talked about much in online forums and really should be, because the difference that can make is really very substantial. And those benefits across the entire investment are really meaningful. So if you take a look at the investment example on the screen there, this is a professionally audited investment example. And if you'd like to see the actual workings for it, please get in touch with me. And I can provide you with some both for UK residents and international residents. But you can increase your post-tax returns by 52 to 66% in this scenario simply by using a limited company. And beyond the tax efficiency side of things, if they're not an incentive enough, there's this other bucket of tax efficient of the benefits even, which is that the first one is probably that the traditional reason people use limited companies is because it protects your personal liability. So should your investment go wrong for whatever reason, your personal assets, or your home and your car and everything else, are much better protected in a limited company structure than they would be in your personal name. Beyond that, you can also greatly improve your estate and inheritance planning. So you can manage your estate much more flexibly when you own a limited company, in the sense that you can transfer shares across to your children in a way that, if done correctly, can mitigate inheritance tax and allow you to retain control over the company whilst also giving away the value of the property to your children. It's also very easy to buy and sell with others using a limited company. So as I said before, you increase your means by which you can sell on exit, and there's some very meaningful incentives there. And also with our platform, you can invest with up to 7 other people. So we allow up to 8 shareholders in our company. So you can basically pool capital together, and more of you can invest for a bigger property. And there's also very well-developed mortgage markets that now exist now. So 4 or 5 years ago, the mortgage markets for limited company buy-to-lets weren't particularly positive. You would probably need a commercial loan with extremely high interest rates of 8 or 9%. And what we've done essentially is we've partnered with a number of the leading UK buy-to-let limited company brokerage who specialize in this kind of thing. And through them, we've got access to about 570 different limited company products. Extremely competitive rates. Now that's both for UK residents and international residents, be they expats or be they natives. And so the cumulative benefits are huge, and they're very much misunderstood. And so the calls I have with Steve's clients at Fabrik and other people, we really want to educate people on just how extensive they are and how they're accessed. Now, traditionally, 2 of the big obstacles to taking the limited company route were the cost and the hassle of doing so. So if we start with the hassle and the complexity, in the past, you would have had to have gotten together accountants and solicitors and bookkeeping services and secretarial services and many other providers. And you would also have to structure your company. Now, a lot of people think, oh, I can just log on to Company's House and set my company up. And well, yes, you can. But the reality is what you have then is just a very simple structure. You know, the true value of a company and where it will truly benefit your investment is the quality of the legal documents and how it's structured. And it's very complex to know how to do that properly. Moreover, it's costly. So the typical cost of running a limited company for buy-to-let properties, including accountancy services, bookkeeping, secretarial services, registered offices, all of those is typically somewhere between £2,000 and £3,000 a year. So there's quite high barriers to entry, and it's very costly process. So what we've done at GetGround is we've basically removed those 2 obstacles. So we've created a platform, a company, where we can basically allow people to access the limited company buy-to-let route very, very easily and really maximize the value of that buy-to-let company. So what we do is we basically take all the hassle off you. And so the first thing we do is that we create your UK limited company for you, and it's specifically designed for buy-to-let property. So it's built to maximize your post-tax profits, to protect the shareholders' liability, and to work with mortgage lenders, amongst a number of other things. We then help to coordinate with your solicitors to help purchase the property into the company. We will then, if you do not have a solicitor, we have a panel that we're more than happy to refer you to. We then set up a company financial account for the company. So that's for all mortgage payments, for rental incomes, for dividend payments, everything like that. And then we manage the company on an ongoing basis. We look after all the accountancy, the tax filing, the legal documents, registered office, bookkeeping, secretarial services, all of that. And so you have a very centralized, easy to access system where we look after basically everything for you, including the setup and the management. And we do it extremely cost effectively. So we do that for a one-time sign-up fee of £500 excluding VAT, and then an ongoing subscription of £20 excluding VAT per month. So essentially you can run your entire buy-to-let limited company for £240 a year, which is roughly 10 times cheaper than anybody else in the market in a very simplified and easy and efficient platform. And so we're trying to educate the market and also make it extremely easy for people to take that route and access those benefits. So that's kind of a cumulative view of GetGround and the benefits of using a limited company. And I'm sure the guys will leave some details after. But if you have any questions, please don't hesitate to ask me after or contact me separately.
Thank you very much, Liam. I'm sure everyone out there is pretty surprised by some of the stuff they've heard. I just want to let everybody know that when Liam first told me, I got so excited. I asked him if he could take the £2,500 accountancy bill that I get every year off my desk. And he said that I couldn't because I didn't set up with them. So I don't get the benefit. So to people out there, I'm paying £2,500 plus VAT a year just for my accountancy fees in that limited company. And you guys can start and pay $240. So I think that's good. Another thing that keeps coming up is people keep saying to me about corporation tax. So I've structured my company in a way whereby I move I have a SAS pension. I'm setting it up now, and I'm going to be moving all my profits out of my buy-to-let limited company into my SAS, and that is a tax-deductible expense. You get £40,000 allowance per person. So me and my wife can move £80,000 a year over into our SaaS, and it comes down off of our corporation tax bill. You know, it goes on our books as an expense. And my bank said that because they can see that it's being invested, they still see it as a strong company. So when they look at the P&L, they don't, you know, think that I'm any weaker. I'm £80,000 weaker. So that's a couple of people out there that queried me on corporation tax. That's how I put more expenses in. So now I'm going to hand over to Jake, and he's going to talk to you about. He's going to give you a global view on the market, because we had Paul Preston on 2 weeks ago, and I think it's the first time I've actually felt okay about paying stamp duty land tax, and I think we'll hear about that in a minute. There you go. There you go, Jake.
Here we go. Thanks, Steve. Thanks for the content. It's great. I love your journey. I love the honest story as well. It's fantastic to hear, and great content from Liam as well. The guys at GetGround are fantastic. I've introduced a lot of my clients over to GetGround. Any investors that are out there, whether it be a first-time investor or an experienced investor, should definitely look at their services, because they're very, very useful. Thanks for having me on. I just wanted to give everyone a bit of an overview, or a global overview of other markets, just a very short overview, and touch on some of the costs. As investors look all over the world, not just at the UK, especially with me being based here overseas, I get asked all sorts of questions, and get asked about all sorts of markets. So there's opportunity out there, and there's some markets to stay away from. So I just wanted to touch on a couple of the markets, and I'm going to start with the Dubai market, because that's where I am. And I'm just really going to highlight the entry costs here. So in Dubai, you have a Dubai Land Department fee, which is equivalent to stamp duty. That's charged at 4%. Then you have agency fees on top of this. They can be anywhere from 2 to 5%, depending on the agent, where you're buying from, what you're buying. You're then buying into a market that is fair to say is heavily oversupplied, and in some areas now is depreciating. There's certainly still some pockets of value in Dubai, but there's lots of areas that you really need to look out for. So a market that many of my clients have bought into, some for investment, some for personal use because they've been living out here. And it's a market that you have to watch closely if you're ever going to invest into it, something you really need to do some due diligence on. Moving on to Spain, Spanish market. You still there?
Yeah.
Sorry, the screen's gone on mine. It's all right, no worries. Moving on to Spain. Spanish market, one that I haven't had many dealings with. However, I get asked so many questions about the Spanish market, mainly from the British expats overseas. Lots of them looking for holiday homes, or small buy-to-let investments that they can rent out as holiday homes. Again, great market to look at if you're looking for a holiday home. If you're looking for an out-and-out investment, probably not the best one to look at. Expensive entry costs, 10% stamp duty, and then you've got some other fees on top. So something really you need to be mindful of again. Moving on to Germany, and more specifically Berlin. Now, this is a market that I've had quite a bit of exposure to. I've helped clients buy into this market, and I'm very fond of this market as well. It's got lots of drivers, much like the UK market. However, one thing I would say is it's more suited to an experienced investor, or an investor that's gone through and at least bought one property in their portfolio, because there's a lot more moving parts in the Berlin market. Let's talk about the entry cost again. You've got a 6% stamp duty there. You've then got agency fees that can vary between 3.5% up to 8%. And then you've got some notary fees, which tend to be around about 2%. And one thing to really watch out for with the Berlin market is if you're buying in Berlin and you're based overseas, you will have to go to the German embassy and you will have to get all your documents notarized. Now that can be a challenge for some investors. Lots of investors like things to be as hands-off as possible. And Berlin is a little bit more hands-on. So more suited to the inexperienced investor. Definitely one to watch out for. Good market, good strong market. And then that moves us on nicely to the UK market. As Steve touched on earlier in the webinar, we've got a great opportunity or window of opportunity to take advantage of the stamp duty holiday. So first-time buyers and homeowners buying property up to £500,000 pay zero stamp duty. And then also the second-time buyers and buy-to-let investors, they're only paying 3% on up to £500,000. So a relatively small stamp duty on entrance. And then you've got agency fees of between 1 or 2%. So much lower than some of the other markets. And that moves me on nicely to talk about why the UK and why the UK specifically. I think one of the reasons why the UK is always going to be a strong market, and probably the strongest market for me to offer to my clients, and I'll certainly always be pushing the UK before anything else, is it's really down to the history of the market. It's a proven market, over 100 years of history. You can look at the land registry online, which dates back to 1965, and it records all of the bought and sold property prices from 1965 to present day. And if you go into the data and have a look at that chart, you'll see that property prices have steadily grown over the years. Yes, there's been ups and downs, as there's been markets that, downturns in markets. We've had financial crashes in the 70s, 80s, 90s, 2007, and now we're in a challenging time being COVID. But if you've held on to property for a reasonable amount of time, and when I say reasonable, I'm talking 5 years, you would have been able to ride out those storms. So you would have always made money. And I think it's always important to, just when I'm speaking to investors, to make sure that they understand that property is long-term. It's not a short-term asset like stocks and shares that you can move in and out of very quickly. Property is something that you'll buy and you'll hold generally for 5 years, sometimes less. If you can make a quick turn on it and sell it and make some money, then great. Otherwise, you need to ride it out. And if you ride it out, you'd always make some money. Going on to why the UK market's been so strong, and I think this is probably one of the most important parts about the UK market, it's the supply and demand deficit. The UK is heavily undersupplied. There's not enough homes across the whole of the UK. The government has a target every year of anywhere between 240 and 300,000 new homes to be built to meet the demand. Pretty much every year they fall short. The last time they actually met the target was in 1966. So you've now got an inherent backlog or undersupply of properties of almost 4 million. I think it's 3.8 million homes. And that's very hard to address. I mean, there isn't the resources in the UK, and there certainly isn't the land to build that many new homes in such a short space of time. So that undersupply or that imbalance will just underpin the UK property market moving forward. And that's why it's one of the safest markets to invest into. As Steve mentioned earlier in the presentation, interest rates are at a record low. It looks like they're going to stay fairly low for the next couple of years and just creep up slowly. So now's a great time to take advantage of that. And any of you investors out there or first-time investors that might be sitting on a small nest egg thinking about going into the market, is it a good time to do it? If your money's sitting in cash, it's devaluing. Inflation's just taking it out. So put it into property, probably the safest asset class out there. That moves me on to currency. For the majority of my clients that are overseas, earning in a dollar-pegged currency, which most of them are, it's a huge opportunity. The pound is devalued by around about 15 to 20% since Brexit. So there's been lots of investment from overseas. And again, currency, very difficult to predict, but currency is long-term. You expect that currency will recover over the medium to long term as you will hold property. So if you're based overseas and you're buying property with your overseas currency, as you hold that property, that currency starts to grow and you're making money on the back end when you sell it. And then lastly, just the last point really about the UK market, really comes down to the ease of acquisition. Anyone in the UK, anyone around the world can buy property in the UK. Doesn't matter where you're from. As long as you're of age, you can purchase. You're buying through a solicitor, so you've got the safety and security aspect there. I mentioned it's a proven market. Cost at the moment, there's some great affordability in the regional cities. Most of the investors I'm speaking to are looking at the Northwest. And you're always going to get safe and consistent returns as long as you do your due diligence, purchase in the right areas, and you're in a position to hold if there are any bumps in the road, you're always going to make some money. So yeah, that's it from me. Just wanted to give you a bit of an insight on some other markets and my views on the UK property, and look forward to answering some questions at the end. Thanks very much.
Brilliant. So I know Paul Allett's probably out there feeling a bit better about paying stamp duty like I was. It does make me feel better when you know that other markets are considerably more expensive. So we just thought we'd finish, because a lot of people that are going to be in this webinar are people who enjoy their jobs, working hard, don't really want to go into property full time, but do want to build a property portfolio. You've got Liam at Get Ground here, who can help you get structured. We've got access to mortgage brokers, but we wanted to talk to you about the benefits of buying a fully managed investment. Number one right now is the discounts. So buying a pre-built unit gives you the benefit to get an early investor discount. Now, I would definitely be advising clients to head to major cities, because that's where the influx of overseas buyers are moving into. I think Jake will probably agree with me that if you speak to someone in Hong Kong or Dubai about somewhere like Blackpool, they probably will look at you like you've got two heads. They want to put their money into major cities that they know and understand. And I know from speaking to Jake and Paul that there is a lot of money coming in from overseas now, which, you know, the supply and demand situation, if there's a high demand in that area, supply is going to decrease and values are going to increase. But yeah, discounts is a big one. At the moment, not all developers, some developers are offering rental assurance for 1 and 2 years. I mean, you get some people offering it for, I mean, one thing I would say, guys, and a webinar that my business partner is going to do in the future, is there are a lot of companies out there offering unsustainable property investments. You know, there's guys out there offering things like 5 and 10 year rental assurances. They don't stack. They won't make it. I mean, you will probably get your property. You know, I'm not saying you won't get your property delivered, but the likelihood they're going to make that whole 5 years of payments is very, very unlikely. And there's a simple way to look. If you're thinking of buying something from another company, even if you're halfway there, you can give us a call. We'll look under the hood, show you on Rightmove how to actually work out what you're buying and go from there. But the guys we're working with, they're offering like 1 to 2 years, which does definitely eat into their margin. But we can see from looking at their build cost, land purchase and sale prices that they've got the margin in it to give that assurance. So yeah, that's a big offer at the moment. Furniture packs, you know, it's a good one that gets thrown in because they're like 3 to 5 grand, which is quite a lot of money. And they definitely make a difference to rentability. If someone can walk into a property and see exactly how it's going to be and not have to worry about moving furniture, they're far more likely to take that property than the one next door that's not got the furniture pack. So that's a good little incentive that's being thrown in. A new unit comes with a 10-year guarantee. So I'd say that's massive, because if you knew the maintenance bills that my portfolio gets hit with in Blackpool, it's high. I get 10 to 15% of my income comes off for maintenance every month. You're not going to get that problem with a new build. So you're going to get far lower, if any, maintenance bills, and you get the 10-year warranty. Central locations, like I touched on earlier, that's what we're really getting behind at the moment. Birmingham, Liverpool, Manchester, and the commuter belt towns around London. They're where we're targeting. I know that there's people on the webinar now that have asked me to look for them in other areas. And yes, we're not saying we won't keep an eye out for you if that's where you really want to invest. We have access to developers all over the country. But city centre locations is really where we feel the returns are, and also the capital growth. I'm sure it was Savills that released a report that said that the city centre apartments have gone up in value more than any other asset class in property, any other property asset class. So that's why we're sticking there. Anyway, thank you so much for all coming. And Lynn, I'll hand it back to you. And yeah, hope you enjoyed. Have I got to unmute you? Because if I've got to unmute you, my head's going to come off, because I don't even want to
Right, I've done. bit of a tech problem.
Someone right there was sleeping, weren't they? They were like...
Yeah, no, sure. So yeah, thank you so much, guys, Stevie, Jake and Liam. That was a huge amount of information and knowledge shared there. Jake, if I can just ask you to unmute. Liam, I think you're already are just ready for the questions, please. But before we go into the Q&A section, Steve, I'm going to just ask you to tell everyone about the 2 exciting giveaways today, please.
Oh, yeah. So our managing
he says.
Not out of nowhere. But our managing director, Dal Anderson, him and our PR company did a UK property guide. It cost us well over £1,000 to correlate the information and put it together. On top of that, there was Dal's time. You know, he's been in the business 15 years. He's sold over £1 billion worth of property. It's a hugely valuable tool, and it's all post-COVID information. So that's the first gift. Now, the second gift is something really new at Fabrik. So there's a guy in Fabrik. He's a bit of a technological genius, let's say, or he's better than me on Excel, and he's created this bit of kit that we're going to be offering to the market. We are going to be charging for it in the future when we get it polished, but at the moment it's in the beta testing phase. So what this bit of kit does, you tell us what your current access to cash is, how much disposable income you've got, and most importantly, what your cash flow target is, what your goals are. We put all that into the computer, and it builds you a plan, and it tells you how quickly, based on the properties we've got access to today, how quickly you can hit your goals. I'll give you a couple of examples. One guy did the test. He was a 6-figure earner, lived in London. He was used to earning over 100k a year. He wanted 100k a year to stop work. He already had about £30,000 a year in property income, net property income. So he needed £70,000. He had £600,000 to invest, and he could hit his goal pretty much instantaneously. Within 6 months to a year, he would be, receiving the return that, could have allowed him to retire. So that was a guy at one end of the spectrum. The other end of the spectrum, there was a guy that only needed £2,500 a month. And, that was enough for him to call it a day at work. He was a younger guy. He had £40,000 and he needed £2,500. He could save about £1,000 a month, I believe. And he could be, retired in 2 years. So, based on the report. So we're offering that for free. So if you want to get in touch with us, we can book you in a consultation call with the guy who built the tech. He'll go through that with you on a call like this, recorded. He'll then send you the recording, send you the report. Whether you buy off us or not, it's irrelevant. You can take that to your you can do that locally or go elsewhere. So they're the 2 gifts.
Perfect, thank you. So everyone, please, I'd like you to get your fingers at the ready here. I feel like I'm on a quiz show, actually. We should have had buzzers, shouldn't we? So, if you could just please put in the chat now. If you would like a copy of the investment guide, please just put guide in the chat and we'll get that across to you. Also, if you would like the plan, please do put plan in the chat and we'll get that across to you. If you'd like an appointment with Get Ground, just type in Get Ground and we'll sort that one out for you. And if you'd like the whole investment guide, the investment plan and the recording, please do put bundle in the chat. So just for any confusion, it's guide, plan, bundle, Get Ground. Does that make sense? Hope so. So, questions. Can I just ask you? Oh, look at you all! Look at you, grabbers there. Yeah, look at that. Not an ebook insight. You all want that. Looks like Get Ground are getting quite a few fans there. Bundle. do you know, when I was at school, bundle meant a whole different thing. I don't know whether it does now, but we just used to all pile on top of each other. But I think they do that in different environments these days. Yeah. But let's just not get into that one. Anyway, we digress. Where's my fan? So questions, just a reminder, if you could please pop your questions in the chat. had quite a few come through privately, but please do just put them in the open chat there, unless of course you want to keep it private. And please just do say who the question is for, just to help out little old Lynne here. So let's see, where shall we start? So yeah, you're all going through at the moment saying get ground, bundle, perfect. Okay, so where shall I start? Stevie, let's start with you. So this one here, what's your best advice to someone like me who has some funds in the bank but not a lot of time to look at building their own property portfolio?
Definitely find a company that can help you do, you know, the fully managed route. You know, we have access to a lot of the UK's leading developers. You know, today you've met GetGround. We have mortgage brokers that will come on future webinars. So you basically want to, first of all, sit down with someone, you know, someone who's been in property as well, someone who understands it, and have a strategy session. So the first thing you do, you sit down, we look at how much cash you've got, what your targets are, what your goals are, and we build that strategy. Once we've got that strategy, we can then connect you with all the professionals, make sure you're mortgageable, make sure you know, you've got your structure in place, and at that point then we can then go out and get you the properties. So I'd say completely hands off. You are going to need to work with like, you know, professional sourcing companies, and you're going to have to just sub everything out.
Okay, thank you very much.
We can help with that.
Perfect, thank you. One for you here, Jake. Which locations are overseas investors investing in, and why?
Most are looking at the regional cities. So you've got your Birmingham, Manchester, Liverpool. Manchester for sure is one of the most popular. You've got Liverpool as well behind, and Birmingham. That's really where the focus is at the moment. It's where all the money is in terms of regeneration from the government. And it's affordable. You've got the yields and you've got the capital appreciation. So safe areas, definitely the regional cities.
Right, thank you very much. One here for you, Liam. I'm going to try and keep going like this, but obviously depends how they come in. Yeah, Liam, is your service just for UK residents, nationals, or can you be an expat or foreign national and still benefit from it?
Yeah, very much so. Anyone can use it, essentially, is the reality. It's one of the joys of our platform is it can be accessed anywhere in the world, both by UK residents and UK nationals and those who are based further overseas. So that applies to expats, that can be foreign nationals. We've worked with, God, I don't know how many countries on the planet now, but it's a high number. We work across Africa. We do a lot of work in South Africa and Zimbabwe and places like that. We work a lot in India, Singapore, Hong Kong, China, places like that. So wherever you are in the world, it's extremely easy. And one of the big benefits that especially international clients find for us is that when taking the limited company route or taking a mortgage or anything like that, lenders require a UK company financial account from which to pay the mortgage from, essentially. And they can be extremely difficult to access and get for international residents. So often, even if you can get one, it takes months and you have to fly to the UK and you have to go through interviews and things like that. And the beauty of our platform is that's part of the package, essentially. And we set that up typically within 1 to 3 days of your company being set up. So we can provide essentially what the lenders need and what's needed for your rental income and everything from anywhere in the world. Getting set up is very, very simple, no matter if you're a UK resident or international.
Perfect, thank you. And one here for Jake from Kaylee. Is now a good time for me to move my funds from overseas into the UK? I'm not sure about the exchange rate and if it's the right time.
Yeah, it's a great time, especially if you've got a dollar peg currency. I'm not sure where the currency is, but for sure, if it's dollar pegged, now's definitely the time. But don't use your bank, use a currency provider because you'll get a better rate and they won't charge you so much.
Okay, thank you. And Liam, back to you here. Steve is asking, would you use a limited company for each property, or can you use just one and allocate the shares to each property?
Using one property per company is by far and away the most beneficial way to invest. So the reason for this is quite extensive, and anybody who wants to know more, please get in touch with me, because it's definitely worth a chat. But one of the biggest benefits to holding a property in individual companies is that you open up the ability to sell the shares. So what you can do there is essentially, when the property is wrapped in the company, you can very easily sell the property by selling the company around it. And when you do that, you obviously get that massive uplift from that stamp duty benefit to increase your capital gain substantially, and you have the lower capital gains tax due on that. Now, there's a number of other benefits that are definitely worth noting. The issue is when all the properties are in the same company, it's extremely difficult to sell a property by selling its shares, because obviously if you had 10 properties in one company, you would not really be able to sell a property by selling the shares, because you're gifting away value in the entire company. Now, when they're each in their own segmented, easy to access company that is very transparent, it's very clean, there's no inhibitors in terms of shared liabilities or any employees or anything like that. It's extremely easy to sell that. We're also regulated by the FC for the sale of shares as well, so we would help coordinate that as well, and any of the complexity around that we would assist with. And so it's definitely most beneficial to invest using separate limited company SPVs.
Lovely, thank you. Liam's also asked us here, Steve's just asked here, Liam, again, could you just mention the possibility of using trusts for your company shares to allow future tax benefits, etc.?
Yeah, trust is it's a funny one. It's definitely one that's best addressed in a call, because it differs per situation. Typically, it's usually best not to, and the reason for that is one of the things that we pride ourselves on, and one of the reasons we do separate limited companies for each SPV is that one of the biggest inhibitors in the past to buying a property by buying its shares is knowing what's behind that company. What's the debt situation? Who are the ultimate beneficial owners? Who are the shareholders? And the due diligence required to really dig in and find out what you're actually buying is extremely costly. And even when you've done it, it's very difficult to be convinced that you're safe to go forward. And so what we've done is, because we set up the company and we can promise that there is no shared liabilities here, here's the entire financial history, here's the legal structure, here's everything you need to know about this company, here's the ultimate beneficial owners, the shareholders are individuals, we know who the directors are. We create these very information-rich companies that are very easy to buy and sell, and therefore reap the benefits of doing them. I mean, if you think about how liquid and fluid the stock market is, you can buy and sell Amazon shares very, very easily. And the reason you can confidently buy Amazon shares is because there's so much information available about them. You know everything about it. You can go on a million different sites and find out everything you need to be confident to go ahead with. And so when you bring trust into the equation, it changes things up a bit, but it's definitely worth a chat. So please give me a shout. It differs per situation is the reality.
I think Steve's going to be booking a call there. So okay. I've got a question from Noff. I hope I've pronounced your name properly, or it could just be your initials. So the question is, I think it's probably directed more at you, Steve. My question is, with leasehold, what are the restrictions on selling it, and what is the difference here versus freehold?
I've sold leasehold properties. I wouldn't say there was much of a difference really. When you're buying a leasehold property, it's really important that your solicitor reads the lease extensively, because you need to make sure you know what you're getting into. With leasehold properties, you have to pay attention to ground rent and service charge. So being a buyer of leaseholds, I always pay a little bit of more attention. So I'd imagine being a seller of a leasehold, the buyer's solicitor should pay more attention. But in regards to conveyancing, I mean, I've bought leasehold properties in auctions within a couple of weeks. I haven't really experienced much of a difference. But yeah, you do need to pay close attention to the lease, the ground rent and the service charge when buying.
Okay, thank you. And Steve, just going to stick with you for a moment here. Valentina, love that name, Valentina. They're asking, is Liverpool good for serviced apartments to invest in at the moment? Right, so serviced apartments, I've done them. I've done a lot of them. You need to make sure you stay under the VAT threshold. It's really important that you don't breach the VAT threshold. The reason being, if your serviced apartments
overshoot the £80,000 and you breach the VAT threshold, you lose 20% of your top line, not your bottom line, your top line. And that's a big hit on your income. Whereas if you can keep your company below that, it is a profitable model. So if you are going to, I can't tell you exactly. I mean, service departments are so location dependent. Like, you literally need to be on the exact right place that people want to go. And right now, I'd say you want to be near where all the action is. Go to the property and walk yourself. How long it takes to walk to the restaurants in Liverpool and stuff like that. You don't want to be walking more than a few minutes, because it's already it's becoming a very saturated market. But really, what's going to happen long term is the top providers in the top locations will come out on top, and they'll be the winners, and then everybody else will have to. And make sure you can flip the property back into resi, so that if it does, like my service departments, I've got them leased out with various different operators, because I found that to be the safest route for me. No maintenance, no management. But if they foul, or if it falls or dies a death, I can flip them straight back into residential. And that's what I liked about them.
Right, thank you. Jake, one here for you. Can overseas investors obtain mortgages?
Yeah, we can get mortgages for overseas investors.
Okay, is that quite easy?
To be honest, yeah. I mean, it's on a very much case by case basis, so it really depends on the person, where they're employed and their location. Mm-hmm. But it's a lot easier than people make it out to be. We've got lending for people in some very obscure locations. As long as you're in full-time employment and you're working for a fairly reputable company in some of these countries, then lending's possible. And there's lots of lenders out there in the market now. So yeah, lots of options. Again, it's on a very case-by-case basis. So it's depending on what you're buying and who you are, effectively.
Right, thank you very much. And Steve, I don't know if you can help out with this one at all. So David Baxter is asking a couple of questions here. I'm hoping you know what this means, because I don't. But David said, do you need an LL license in Liverpool? You know what that is?
That's a landlord license.
Okay.
I think it's a yes. I recently had this come up. I know you need them in Blackpool. I'm pretty sure you need them in Liverpool. I think they're about £300 a unit. They're like a license to let.
I think it's run out in Liverpool now. I think it ended this year. I think over the last 5 years. There's licenses that you're supposed to have in all sorts of locations, but they enforced it quite hard in Liverpool. But it wasn't. They tried to extend it for another 5 years, but the government rejected it. So anything you're buying in Liverpool now, you won't need to have one. But yes, you will have to need one for some existing properties there for sure.
Oh, that's good. I've been telling people they've got to pay for that, so I'll go back on that.
Thanks very much, Jake. That's great. And also David is asking, do you only deal with off-plan new builds?
No, not at all. I mean, we source land for housing associations, funds, family offices. We find money for large companies. The arms of Fabrik, are very varied. I mean, off-plan, we get off-plan and completed stock. We've got something now that completes in the next couple of months in Manchester City Centre. We're just taking on something in Liverpool Docks that is already completed. So yeah, we're completely across the spectrum. I mean, there are things that I get asked for where I say, look, I'll put it in, I'll keep it stored up here. I'll tell the team, and it might not come up, like, retail in Leeds and stuff like that. That stuff I don't really get. But no, we deal in a lot more than just off plan. Lovely,
thank you. So one here for you, Liam. Yogesh is saying, in addition to buying properties with an LLC company, I don't know whether they mean limited company, would it be a good choice to buy shares from other companies as well?
Muted. Someone's got unmuted.
Can't hear a word you're saying. We've got our tech guys in the background that can help us out here, please.
Yeah, I think I'm in now.
You're in.
There you go. Lynn, would you be able to repeat that question again, please? Sorry.
No. Once I've said it, it's good. No. I'm joking. So in addition to buying properties with an LLC company, but I think they mean limited company, do they? Or am I just being naive here? Would it be a good choice to buy shares from other companies as well?
I don't really know if the question's in reference to property, as in buying other shares from other property companies, or if they mean the stock market in general or other companies. Right. If it's with regards to property companies that exist right now, I don't see why not. I think it's quite a savvy thing to do. Again, it gives you that benefit of the benefit of buying shares in any property company is that you can invest with less, is essentially. So rather than buying the property outright or buying the majority stake in it or whatever, you can invest a little bit and get some amount of returns out of that. Again, with the he did say property companies. Yeah, it's not something we really deal with ourselves. I know there's a couple of clients who do it, but it's definitely not. I think property funds are quite a popular thing these days as well. Crowd property funds, and crowdfunding in general. But again, it's not something that we really do on our platform. But it's very much personal choice now. There are a lot of people doing it in the market, so I see no reason why not.
Okay, thank you, Yogesh. Actually, let's stay with Yogesh for a moment. They're also saying, does the company give opportunity for visa sponsorship for expats?
Yeah, it's a complex one. The reality is, any footprint in the UK, the more of a footprint you have, the more your kind of case is better argued for anything like that. So for visa sponsorship or anything. So again, we don't deal with that specifically, but I know in terms of lenders and visa sponsorship in general, the more of a footprint you have, the more kind of trust that the lender or the government can have in you, and knowing your background and everything else helps massively. And that can be from having a single buy-to-let property to having more, to having family here or whatever it might be. I think that the more of a footprint you have in the UK, the better, essentially.
Perfect, thank you. Stevie, I've got one here for you, and I know that you and I are not people to avoid things in life. We just like to be confronted and get our opinions out there. So here we go. I've got quite an abrupt question, I suppose you could say, come in, but I'm going to ask it anyway. So yeah, Stevie, for you, what are you trying to sell me here?
Well, I'm only selling if you're buying.
Love it.
Look, we do want to put education out there, but obviously we're a business. We've got multiple ways we can help people. So number one, we can help build the portfolios via off-plan or completed property route. We source land for developers. We help companies obtain finance, so larger finance deals through family office connections and funds. So it was a bit of an abrupt question, but in regards to how do we help? We help by building portfolios and connecting landowners with buyers and stuff like that. Did that answer the question?
Yeah, I think that's probably what he meant, actually. So, well done. I'm glad you had that question, not me. But anyway. So, Tom is asking, this one's probably for you, Liam. So, would you have each individual property in a company then owned by a group?
Yeah, it's people have this kind of holding company notion come up a lot. No, I don't know if he's referring to holding companies. If he's asking, would the shareholders own the company? So would the shareholders of the company be another company? Again, typically not advisable and not something we allow for, again, because it removes that transparency element that is crucial to being able to sell a company by selling its shares. So knowing who the ultimate beneficial owners are, who's behind the company, is extremely important. And the best way to do that is for individuals to own it, essentially. And so we're directly funded in part by the UK government. So we're supported by the government through HM Land Registry. And one of the reasons they do is because we're creating these very transparent structures that are perfectly built for buy-to-let investments and perfectly built to maximize your returns on them. But kind of part of our commitment to that is keeping them as transparent as possible. So having other companies own them removes that kind of seal of transparency. With holding companies, if that's what he's speaking about, holding companies are slightly misunderstood. That there's this notion that they somehow have these additional tax benefits and these other benefits, and that really it isn't the case typically. That they're not that important for that. I think sometimes people think having a holding company would be easier because all the profits are kind of funneled into the holding company, but it's the kind of beauty of our platform as well. I'd be happy to give anybody who would like a demo of the platform a run through at some point in the future. But it's basically the platform's set up in a way that almost the platform itself acts as a holding company. So all your separate SPVs funnel into the platform. You can see your properties on an individual and micro level, and you can see your portfolio on a macro level. You can understand things on kind of a case-by-case basis, see what's working for you, what's not working for you, who's paying rent, who's not. You can dividend out standing orders from your account to yourself on a monthly basis if you want, or you can let funds accumulate. And the holding company is a question a lot of people ask us, and once we've had a chat with them, they realize, actually they don't need it. It's more something they think they need rather than anything else. And it's not the case. If there's large bulk purchases, we consider allowing holding companies for a number of reasons, but typically it's not really necessary.
Okay, thank you. And Liam, I'm going to stay with you for a moment here because Tiravan, hi Tiravan, how are you? Tiravan is saying, if an overseas investor wants a capital and cash strategy simultaneously, what's the best way to structure that from a tax perspective, limited and holding company?
Again, with the holding company, it's probably Tigran, please reach out to me after. It's definitely a conversation I think we should have. These situations, I mean, regarding setting up and how to structure things, I'd love to give a kind of more comprehensive answer, but it is simply a case-by-case basis, and it's why these half an hour long chats are definitely needed. A cash and capital strategy. Yeah, I can't really give an answer. I'd need to speak to it on a case-by-case basis to find out a few other factors. But please reach out to me, and we'll take you through with that.
Yeah, Tiravan, we can certainly put you in touch with Liam there. So Claire is actually saying in Manchester, it's council dependent. So I think that was in respect to when we were talking about Liverpool probably. So thank you there, Claire, for that. Stevie, they're coming in. If I'm looking like this, guys, it's because it's coming in on the chat, coming in privately, getting emailed, getting phone messages. So I'm kind of like this. So bear with me. So Stevie, one for you here. There are lots of investment options out there. How do you know which ones are the best to go for?
The strategy session. It's all in the strategy session. It's your goals. You really have to think what your goals are, how much cash you've got. Like I'd be having a very different conversation with, say, someone who had 10 million in the bank to someone who had 100,000 in the bank. And, the goal, it all relates to the goals and the strategy. So sit down, think about your why, get that first, look at your plan. Then that will take you to a certain location. That if your plan is for income and cash flow and to reach retirement quickly, you're probably going to end up going northwest. If it's more, cash flow isn't really a problem for you, you're wealthy enough, then you may come further down the country to Birmingham, where you're likely to see more capital appreciation. And it could be a mixture of all of the different locations. I know there's a guy out there in the market at the moment. He's buying around 200 units a month. He's an ultra high net worth, and his strategy is to buy stuff all over. He wants 10 in every development that comes up that he can. With reputable developers. He's a switched on guy, but he's spreading his risk. So it's all in the strategy.
Perfect, thank you. And Jake, I think you could probably take this one. Do you need to get a landlord license per unit, and how long do they last?
So we're talking about Liverpool here again now. For anything new, buying in Liverpool, I believe you don't need them anymore. In terms of a landlord license, I would expect it will last 12 months, but that's something we can get back to you on and give you a bit more details on for sure.
Right, thank you.
Blackpool is every 12 months or something, every 2 years. And my property manager sorts all that out. He just takes it out my rent and tells me why the month it happens. So if you've got a good property manager, I mean, them things are just part of the process. You know, bills like electric certs and gas certs and boiler.
Yeah.
It's all part of the process.
Perfect, thank you. Another one for you here, Steve. What do you look for in a good mortgage broker? Interesting.
I want them to have access to the market, the whole market. There's a variety of different types of property, so I want them to be specialists, and recommendation really. And I know I can pretty much, it's the responsiveness that you get from them, the proactiveness, and that a good broker will always ask what your long-term plan is. He'll always want to know long-term what your plan is, because every mortgage is different and he doesn't want to put you in a mortgage that affects your long-term plan. So a good broker should be asking you stuff about, you know, about your strategy again, but proactiveness, recommendation, they're the ways I try and look for.
Right. Thank you. So, Jake, one here for you. Do you see the UK market remain strong?
Yeah, I mean, it's really sort of backed by the undersupply, investment that's gone into the regional cities. The attraction of the UK is always going to be there. There's obviously going to be a big change in people's working habits over the next 12 months, 18 months as we go through the rest or the back end of COVID. But I certainly think the market's going to stay strong. It's a very resilient market, and it's there. It's proven, isn't it? It's the proof's in the pudding, as they say. All the data's there to see, and I don't see that changing anytime soon.
Steve, would you agree with that?
I would completely agree with that. I mean, you know, it really did hold me up. It held the Fabrik group up. It was a fantastic, resilient asset. People in the UK really value their homes. They will pay their rent, even the commercial tenants. You know, we're quite we're an honourable country. We do pay our bills, and that rank. I mean, gym memberships were the first things cancelled, weren't they? But you weren't not paying your rent. You know, you wanted to. You know, that was a big part of your what you wanted to pay. So
yeah, no, absolutely. Yeah, and actually just going back to when you were talking about your rental payments of your tenants, Stevie, at the beginning, I mean, you know, we have a very small portfolio, my husband and I, but and I'm not for one moment suggesting that everyone does this, particularly when you've got 50 properties out there, but, you know, it's been a tough time, and we've been very grateful for our tenants not asking for payment holidays. They could have done. And just as a little thank you, we've actually sent them Amazon vouchers. So I think as well, you know, you have to remember that whilst we purchase these properties as landlords, that, you know, we're very grateful for these tenants to be there. And I think, you know, it goes a long way to show a bit of appreciation sometimes.
You know what? I agree. One of my commercial tenants paid me every month on time. He had a restaurant, clearly had no customers. Really, you know, and my manager called and said, Steve, his window's been smashed. It's £280. Would you pay it? Now, I went into businessman mode and went, I've got to read the lease. And he went, come on, Steve. It's been the coronavirus. The guy's got no customers. Pay for the window. And I was like, right, yeah, I will. And I'll be honest with you, that is another sign of a good manager. He wasn't completely on my side, completely on his side. He just did the right thing in the situation. So, yeah, I agree. It's,
definitely, you know, and that might have bought you another 5-10 years with that tenant in there. Everything. My personal view is that everything in life, and certainly with property, it's about the relationships that you build, and the relationships come first and foremost. So, yeah, that's probably bought you, you know, if he wasn't great already, he's going to be definitely great now. I'm sure of it. So thank you. I answered a question. Get me. Anyway, so moving swiftly on. So got lots and lots of thank yous coming in here behind the scenes and in the chat. Claire is actually saying Fabrik really helped me out with this 12 months ago with my strategy. Thanks to Matt for that. You taught me things I use daily now. You're a great team. That's lovely. Thank you. Ashley's saying this is very good. Thank you, Ashley. David's asking, would you recommend buying in the northeast period, or what about a cash flow strategy? Steve, probably for you, that one.
Again, it goes back to your plan and your strategy and how much money you've got and whatnot. Because, yeah, you know, Blackpool has been great to me, and I'll always invest in Blackpool. But I do wish I was a bit more diversified in major cities, because they have shown a high level of capital appreciation. So I think you need one, let's have a strategy session. Let's look at your access to funds. Let's look at your plan. I do know that someone the other day said you can still get 50 grand houses up there that cost like $450 a month. I mean, I don't think 50 grand houses are going to be around for long. They were around in Blackpool when I first got there. They're gold dust now. You just can't find them. So tough one. I think it depends on your strategy, but you have to take capital appreciation seriously. Like, you really do. You know what I mean? It's, you know, cash flow's great, but always have an eye on the capital appreciation side of things as well.
Yeah, absolutely. Steve would love to get a plan in place to grow going forward. Yet Steve will do that for sure, and the recording. Mahmood is asking, how much does it cost to put existing property into a limited company like stamp duty? Liam, that's probably for you.
Yeah, so it's a pain, is the reality. So unfortunately, if it was different, we would eat up the market. But when you transfer a property from personal ownership to private ownership in a limited company, in the eyes of HMRC, that counts as a sale. And so what that incurs is stamp duty, land tax, and capital gains tax. Now, that said, now is probably the best chance you're ever going to have to transfer over. So if what you need to do, in fact, Mahmood, I think we spoke over email a couple of days ago. I think we're setting up a chat for next week. But if you crunch the numbers right, sometimes it actually is worth doing it. And because the SDLT for properties under 500,000 has changed, obviously, in the last couple of weeks until I think it's next March or next February, now would be the time to kind of jump on that. And if you want to transfer across with kind of a lesser penalty, that would be the time to do it if the numbers work out for you. But unfortunately, as I say, there's what you can do is you can basically, if you hold your property in partnership, it's very easy to transfer over immediately. If you want to put it into partnership, and we have partners who can help you with that. The issue with that, though, is it takes 3 tax years until you can do that, and so that you can qualify for the SDLT relief. So yeah, typically it can be quite costly. However, usually the lower the value of the property, sometimes actually that SDLT hit isn't that high, especially now, considering they've removed that 2% at the start. But yeah, there are the costs to doing it. So there's a capital gains tax and stamp duty, land tax. Do remember you do have a capital gains tax allowance, so that's always a big benefit. So if your capital gain isn't too great and the SDLT isn't too great, actually sometimes it is worth putting in across. But it can be quite costly. We do accommodate people doing that. We have lots of clients who do put their property from personal name into limited company name. It's just whether up to them after they've crunched the numbers, it's worthwhile for them to do so. But again, remember, let's have a chat about that next week.
Yes, my wife, Holly, she had to move her property from her personal name to a limited company, and it was painful because you can't move it over. We refinanced it into it, and I thought I'd be clever and put the finance amount down as the sale price.
Yeah,
and that doesn't wash, so it has to be market value.
Yeah,
so that then it made it, more money. And on top of that, but one positive to look out for is there are multiple capital gains tax reliefs. We managed to get Holly 4 tax reliefs on one property, but she still had to pay like £7,000. So even with all them reliefs.
Did you not help your wife out, Steve?
No, to be honest. She's got to earn her own living. Well, she's got to, hasn't she?
I knew that would provoke.
Just hit me up for she wants a beauty salon in the garden, so she's just hit me up. She's a grafter. We've both worked really hard to get where we have. So no.
Yeah, she's a definite doer, that's for sure. So Mark is saying here, Jake, actually, I don't know whether this is one for you, saying, I'm concerned about close future. Do you think we're going to see a raft of repossessions as the furlough ends? So it's better to wait in case there are opportunities?
It depends what you're buying, really. It's a difficult one to judge. You know, if people do lose their jobs and they are leveraged too much and they can't afford their properties, then unfortunately they will have to find a way out. In the space that I'm working in tends to be the off-plan properties in key cities, city centre locations like Liverpool, Manchester, Birmingham. It tends to have a professional tenant in there that's a little bit more protected. On the flip side of that, if you're a landlord, you're going to find a lot of first-time buyers deciding to rent again this year. A lot of people moving out of houses into rental accommodation. So I think it really depends on the location and the type of development that you're looking at. But I do genuinely think a lot of people will move out of properties and into rented accommodation. So I do see rents going up more than anything else. There will be some repossessions. But that might be at the lower end of the market in certain areas, in condensed areas. So it really depends on what the client's looking for specifically. Yeah.
Perfect, thank you. Paul saying...
strategy as well, Jake, I'm sure you'll agree. Like if someone has an amount of money and they've got a plan to get to a certain target, then you can get there. If you look at the numbers, you can make your decisions quicker. Sometimes I think you can get paralysis by analysis, waiting for the perfect deal to come along. The quicker you can get cash flow, the quicker you can compound the cash flow. So
100%, yeah. And that money sitting in the bank is, like I said earlier, it's not doing anything apart from devaluing. So
if it does go that bad and they lock, like, you know, it could doomsday, they could lock lending up and people not getting loans, and then you'll regret you never took a loan. You've just got to think what's in front of you, look at your plan, and make your decisions based on the numbers in front of you. But yeah, I agree with Jake as well. Like city centres with professional tenants and all these big companies moving in, I think they'll hold strong.
No, absolutely. Okay, we've got many more questions coming in here, guys. You happy to stay on here and get through these?
Yeah,
sure.
Perfect. Thank you very much. So Paul, second biggest fan, as I said, is saying, excellent webinar. Thank you. Steve's comments on the buy-to-let market is music to my ears. And Steve's asking, Steve, what do you think will be the best areas for growth over the next 10 years? If you were to start again today, where would you go?
I wouldn't say I wouldn't have gone to Blackpool, but I'd have had a more mixed strategy. I'd have stuck to the Northwest. I probably wouldn't invest. Me personally, I mean, it depends on how much money you've got, but the Northwest is a good place. Liverpool, Manchester. But, you know, there's a place in your portfolio for pure cash flow, like Blackpool. But yeah, Northwest.
Perfect. And Liam, let's go back to you now. Do you need to pay capital gains to put current property? Do you need to pay capital gains to put current property?
Yeah, I think what they mean by that is, do you need to pay capital gains tax to transfer from personal ownership into limited company ownership? Unfortunately, yes, that is the case. So if there's a capital gain on the property, you will have to pay that again. In the eyes of HMRC, it counts as a sale. However, do remember you do have that £12,500 capital gains tax allowance. I've also been crunching some numbers on my phone as well, just regards to SDLT and transferring across and things like that. if you, I mean, the SDLT, I mean, that change in the government recently has really shaken things up and lowered things in terms of penalty-wise, in terms of changing things across. So what would be an option, I think, going back to that question before about the SDLT transferring over, is if you transferred your property into limited company name, you would be hit by the SDLT. However, you can actually claim back, if not the majority, if not the entirety of it, if when you sell the shares, because you have that price advantage, you can essentially increase the price of your property because the buyer is paying a tiny amount of SDLT on the price of those shares. And if you do that well, I think there's no reason you can't actually cancel out that cost. So actually, if you were to, say, right, okay, on exit, this is how I'm going to sell, you would basically recuperate that stamp duty cost that you were paid to put in the property. And you would also have lower capital gains tax on any capital gain that would have occurred because you'd be selling the shares. So I think there's actually a viable way of doing it at the minute. And I think it's definitely something to at least have a call or a chat about, or crunch the numbers yourself if you want to. Because, I mean, for example, I was looking at a property of £150,000 there, and the stamp duty due on that was, I think it says for an additional property, £4,500. Now, if you transferred that across and paid that £4,500 in stamp duty on exit, the stamp duty, if there was a bit of capital appreciation, would be just over £5,000. So if you increase the price and told the buyer, well, you're not paying the stamp duty that would have applied, there's no reason, I don't think, you could charge the SDLT penalty that you paid in the first place, and then reap the benefits during ownership of having your property in a limited company. So I think there's definitely ways to explore there, more than there was in the past. But unfortunately, yeah, capital gains tax will apply. But again, as long as your capital gain is not too high, it probably shouldn't sting you too hard.
Thank you. Jake, Mark is asking, is it becoming harder to get buy-to-let mortgages?
There was a period when sort of lockdown came in and, COVID was rife. Some of the lenders actually pulled out of the market, but it was a very short-term reaction, and they moved back in quite quickly. So I think it comes down to what's going on in the current market. At the time we had lockdown, so you couldn't get into properties to do valuations. So lenders were seeing it as a risk. There was desktop valuations being undertaken, which aren't always correct. So loans to values weren't quite right. So you did see some lenders pop out of the market for a short period of time, but you've seen them all bundle back in, plus many more now. So there's lots of options out there. It goes back to what Steve said, speaking to a good mortgage broker that has access to lenders and knows the market and knows the product that you're buying, whether that be commercial, whether that be off plan, or whether that be resale. They can find you the right lenders, and it's really important to have that relationship with the correct broker, because there are so many options out there that people don't have access to and people don't know about. But to answer the question broadly, no, I think there's lots of options, different people with different circumstances.
Thank you. We've certainly found that a few weeks ago, looking for a mortgage, and what wasn't there then is there today. So it pays to actually really look pretty much every day at the moment, doesn't it? Things change daily. So yes, thank you. Tiravan, so it's not a question actually. He said he's got a shoot to reprimand some kids who have got out of bed. Lots of love, you guys. Thanks again. David, Steve, this is for you. David is saying, quite simply, why Blackpool?
It's a good story though. So we were in St Helens and we were hunting for deals. I wasn't that young. I was like 24, but I had a pot of cash and I'm looking for deals, and I couldn't find anything based on the model that Matt had taught me. And we found a couple of houses, but it was really slow. I said, I need deals, I need to earn money quick. And this guy that I used to drink with in the city, he was a receiver, and he said, I've got something you might be able to sell. He said, it's a 64-bedroom hotel. It's got 4 flats in the bottom, a sports bar. He said, I need 50 grand for it. And I was like, what? I was like, is there a zero missing? And no, it's 50 grand. So I rang this woman I knew. She was an Asian woman. She was a good friend of mine. She would source investors and I would find property. And she sold it in a day for £100,000. And we split £25,000 each. And that was the most money at that point we'd made in property. So it was in Blackpool. So I went to Blackpool and I was ringing around the agents, and one guy went, oh, my dad, he was at one point the largest property owner in Blackpool. He had 2,000 properties. So I went, well, I'd like to meet him. And his dad picked me up from wherever, I think it was a station, can't remember now, but he drove me all around the town and showed me all the positives and negatives, and look, this area is bad, this area is good, and you know, and then he put a few deals in. He took me to a developer's office and put 3 deals in front of me, and I think I bought all 3. Literally, because I just looked at the numbers, looked at the valuations, and I was like, they're all deals. In hindsight, they weren't the best deals, but then we just stuck in with it, and we got to know the head of planning, the council, planning consultants, and we are really the largest land buyer and developer in that town now. So we've got a good little thing in that town. You know, we get on with all the council and stuff, which is nice.
Perfect. And I think actually this is the last one for you, Liam. Is it easy to set up a limited company for buying property?
Yes, I mean, one of the things we take a great deal of pride in it is how high quality our platform is, essentially. I mean, we've put an unbelievable amount of money and time into designing the platform. I think it took about 1.5 years to fully get it operational to a point that we were happy. And basically, I mean, from anywhere in the world, you can basically onboard yourself and design your company in 20 minutes, you know, start to finish. Once your KYC documents and everything have gone through, I would say as long as everything checks out, your property company is probably ready within a day. The financial account ready within 1 to 3 days after. I think the quickest company we ever did was about 48 minutes start to finish, web filed on company's house, ready to literally purchase property into it. Typically, most people aren't going to need it in 48 minutes, but that's just kind of testament to how much of a good job that the tech guys have done on our team. Very, very easy. All you would require from anywhere in the world would just be your property details, so purchase price and the location, a copy of your passport and a copy of your proof of address. We have a customer service team who would be very happy to, you know, run you through the process and even guide you through it, but it is a very simple process. And, you know, if you're doing it with other providers and you're going after accountants and solicitors and people to structure it for you, it takes, you know, weeks essentially. It's a real hassle and a real cost. With us, it's 20 minutes online and maybe an hour per year in admin is really all it is. And so it's a very, very easy and simple.
Lovely, thank you. So just the last one coming in here, which of course I have to say out loud. Keith Whittingham is saying, fantastic session, guys, very informative. And well done, Lynne, awesome as ever. But there you go.
I don't know if the other boys vouch, but thank you, Lynne. You've been
yeah, no, fantastic.
Fantastic, Lynne. Great.
Thank you very much. So yeah, lots of thanks, guys, coming in here. Great honest presentation, very interesting. Thank you all and speak soon. I will just say to absolutely everybody out there, you know, please do know that if you've got any further questions at all, you can contact myself however you want to find me, whether that's, you know, personally on WhatsApp or through Facebook, LinkedIn. Of course, contact Fabrik directly and Liam, and also got to say it one more time because it's just such an awesome name. Gel, and he said gel, got it wrong there. Jelly. Jake El-Rousal. What an awesome name. So, guys, thank you so much once again for taking the time for all of us today. Extremely informative and very much appreciated. Lots and lots of thanks here coming in on the chat. So, everyone, thank you for joining us today. We'll be bringing another webinar to you on Thursday, the 6th of August. So, please do look out for the link on that one. I'm sure you'll probably get an email from us as well. So thank you all again for being with us today. Truly, truly appreciated. Stay safe, stay well, make money, do good business, and see you all soon. Take care.
Thank you.
Thank you.
Bye-bye.
See ya.
Bye-bye.